Happy Friday, everyone, and welcome back to Your Finance TV. As always, we have Jay Pelosky here. How are you, Jay?
Hi, Scott. Nice to see you, and nice to see that wintry backdrop there with some snow finally here in New York City, right?
There's actually some coming down right now. The camera on the computer is not the best for that sort of side, but it is coming down right now. But I'm not a big fan of the snow. I'm more of a summer guy myself. But I'm a little concerned about you today, Jay. Like I've seen the title of your headlines and your musings, March or May, who cares? Now, Jay, I feel like I have to give you a hug because I always care. But go a little bit deeper into the title on that one for us.
Hey, I have to say before we do that, that I loved your cover on last week's We Got Legs, adding in ZZ Top there. Very nice, my friend. Very well done. We appreciate that graphic. That was cool.
You're
Yeah,
welcome.
so this week, not as I'm not sure if you're going to find an album cover to represent March or May. Who cares? But it really boils down to everyone's focus on the Fed, and primarily on when is the Fed going to cut and how many times the Fed is going to cut. And we feel, and we've written about it before, but want to really kind of headline it this week. We feel strongly that it's the why, not the when, of Fed rate cuts that's really important. And history shows this quite clearly. When the Fed cuts because inflation has come down such that real rates are overly restrictive, stocks do well. When the Fed cuts because we're about to go into recession, stocks do poorly. And where are we today? Right? The latest Atlanta Fed nowcast for Q4 is pointing to 2.4% growth, real growth in Q4. We'll get the first read next week. Where's inflation and rates? Inflation on a 3-month basis, whether you look at core, PCE, or CPI on a 3-month annualized basis, all running around 2%. Where's Fed funds? 5.25, 5.5. A massive real rate environment versus the Fed's real rate target of 50 basis points. So to us, it's pretty conclusive. Whenever the Fed cuts, and we think it's more likely going to be May than March, but if it's March, that's fine. But whenever the Fed cuts, it's going to be because of real rates being overly restrictive. And that is going to be, we think, constructive for markets. So we're much more focused on the why than the when. And we think investors should really take that on board.
Jay, you've written in your musings this week about the unique setup that we have in the marketplace right now. Dig into that a little bit for the readers, and they should actually be reading the musings anyway. They can go to pelosky.com to do that. But dig into this for the viewers.
Yes, hopefully somebody does, other than you, does read that. I mean, that's one of the things about today's day and age. I mean, obviously we have clients of our model portfolio delivery service who get the musings as part of that service, but then we also have our distribution list, and so we send it out to many folks over the course of today. But you don't always get a lot of feedback as to what people think. So anyone out there, go to Pelosky.com, sign up for the musings, and feel free to email me and let me know what you think. But yeah, to your point about the unique setup in today's environment. And this is, I think, even perhaps more important than the when versus why, or the why versus when about rate cuts. The setup we're in today is virtually, is almost unique. I don't want to say virtually, almost unique. Right, where you have the Fed cutting and earnings growing. Typically, when the Fed cuts, earnings are falling, right? But we quote, actually take a direct quote from the Wall Street Journal story on this, where the journal pointed out that the uniqueness of this environment and reminded folks, its readers, that the last time this happened was in 1995 when the Fed cut and earnings grew. And by the way, in 1995, the S&P was up roughly 35%. Now, we're not expecting that type of return, in part because we're starting off at a fairly high valuation for stocks. But as the journal ended its story, rising earnings and falling rates tends to be pretty good for multiple expansion as well. So it's quite conceivable that we could have, another double-digit type return year for the S&P. And that's something that we don't think investors have really cottoned on to, right? The idea that we're in a very unusual environment where two tailwinds that historically do not work together are likely to be supportive this year: falling rates and rising earnings. And so for us, this also reminds us of a lot of the work that we've done really now over the last 18 months in talking about 1995, because that's been an analog that we've been using since the middle of 2022 in our view of a global CapEx cycle supported by technology keeping inflation down, allowing for a sustained period of high growth. And in this case, we think in 95, it was US specific. In this case, we think it's going to be global because the CapEx boom is meant to deal with the three C's of COVID, climate, and conflict, much of which is global. Thankfully, the conflict is not, though it may seem to be when you pick up the paper. But certainly the COVID reaction, and particularly around the regionalization of supply chains and the onshoring of things like semi-fab plants and EV battery plants, et cetera, all that's also serving to kind of reinforce our framework, which is that idea of the tripolar world, regional integration in Asia, Europe, and Americas, really being driven by a lot of what we see happening today. And as we've talked about, that's something we're able to invest in, particularly using emerging markets, which we think selectively are going to be the big beneficiaries of this regionalization process.
Jay, a lot of people are going to be looking to earnings next week. Obviously, some big names are coming up. Like you mentioned rate cuts and so forth. What would you rather have, extra rate cuts or double-digit earnings outlook?
See, whenever I wonder whether folks read it, you always, that's why I love these Friday get-togethers, because you're a guy who's clearly already read the musings, and you're ready to go with your questions, which I really appreciate. So thank you for that. And yes, that is the question, right? I think at the end of the day, it really does boil down as an investor to a simple question: would you rather have 5 rate cuts instead of 3? Or would you rather have double-digit earnings growth, which is the forecast for 2024? Certainly here at TPW Advisory, we'll take the latter, right? We want the earnings growth because there's nothing that's more supportive of rising stock prices than rising earnings. So that question is one we think, again, is easy to answer, but you have to get to the question, right? I mean, with all that's going on, it's so easy to get distracted and so easy to focus on the wrong thing, the latest shiny bubble, the latest geopolitical concern. The simple question: rate cuts versus earnings growth. We want to see that earnings growth, and we think we're going to get it.
Okay, now we've talked a lot about macro surprises that are floating around, and you talked about it like with your year ahead review and so forth. What's the focus there right now on those? Like, so many updates have happened, even in the space of like 3 weeks, essentially, or the 19th. Like, what else is changing?
Yeah, no, again, great question, and a good reminder to the audience that we wrote our 2024 outlook back in October, right? And it was titled Surprise, Surprise. And we highlighted 4 macro surprises. So 4 things we thought would surprise on the macroeconomic front, and then 4 market surprises. And so, that's a great guidepost for us as we go through 2024. We can be tethered to like analyzing those 4 surprises. And so the one we're focused on now is number 4, in what we call the 4 for 24 surprises. And that surprise is the resolution of the debate between early cycle economic recovery and late cycle imminent recession, right? And for the last year plus, people have been on that recession story. And finally, it's starting to recede a little bit. We don't hear as many people talking about it as much. I mean, given that 2023 GDP growth is likely to be between 2.5% and 3%. If you're a recessionista, you got to give it up at some point. You know, BS has to walk at some point. And so we are increasingly of the view and seeing more and more signals that we're in early cycle. And let me just give you a few real quick. The first is on the earnings side, right? Here we follow Dr. Ed Yardeni, who's been doing this even longer than I have. And he pointed out that the earnings recession was actually in the first half of 2023. And Q3 2023 was the first year-over-year growth in earnings for that quarter. We think Q4 2024 is going to be the same. And more importantly, looking into 2024 and 2025, so the next 2 years, the consensus is for double-digit earnings growth. And sure, that's going to change a little bit and maybe go down and maybe go up. Typically, analysts are a little bit overly optimistic. But still, the point is, if you're an investor in January of 2024 and you're looking out at 2 years of double-digit earnings growth forecast, you can be relatively confident that stocks aren't going to go down big, particularly if your macroeconomics are supportive of an early cycle pickup. And so let's just talk about a couple that we've noticed. The first is the semiconductor cycle. Clearly, semis are bottoming and starting to turn back up. TSMC, the big leader in the space, was out this week with earnings talking about 2024 being the bottom and the beginning of a multi-year pickup in semiconductors. Have you looked at SMH, which is an overweight position for us in our global multi-asset model? Clearly breaking out, right? The second is housing, right? Mortgage applications up double digits last month. Housing starts up. Mortgage rates down now at a 6-month low. So that we've absorbed, again, the big spike in rates, and then now we're back to where we were in May, before anybody was really super worried about rates for mortgages. Traffic is picking up in the housing space. So that's another example of an early cycle pickup. And then the third would be in the industrial production side. We're seeing signs of things like electrical equipment and other kind of capital good type or in between capital goods and intermediate goods starting to reflect and inflect upwards. And so it's a little tricky, Scott, you know, month over month because the data is noisy. But our buddy over at Pinecone Macro, Chase, puts up these charts of, you know, over a year, and you can really see very clearly inflections upward. And retail sales is another one. So semis, housing, retail sales, all inflecting upward, gives us a lot of confidence that that debate between early cycle and late cycle is going to be won in favor of the early cycle. And that reinforces that double-digit earnings outlook for 24 and 25. And those things going together are, again, you know, constructive for risk.
Funny you mentioned 2025, because I think I'm going to have to start a campaign for Jay Pelosky to be at Davos in 2025, because there seemed to be a lot of negativity there. I'm not the biggest fan of the event as it is. It seems to be a lot of hot air, especially someone who's focused on ESG. What do you think came out of Davos of any note this week?
Well, you know, and when we touched on it last week, right, when in our piece, We Got Legs, where we talked about geopolitical risk being kind of a backhanded compliment to our macro surprise number 3, return to stability, right? We're of the view that we're coming out of several years of upheaval, dealing with COVID, inflation spike, central bank response, et cetera, supply chain upheaval. All that is over. And now we're coming out on the other side. And we see a return to stability, which is going to be very, very supportive, again, of rising assets, particularly, we think, in parts of the emerging markets, as well as in the commodity space. And those are our 2 areas of focus. So we see this as being constructive, in large part because of that huge amount of money, now close to $9 trillion that is in money market and CDs in the United States. Almost $9 trillion. And so, of course, not all of that's going to go into the markets, but some of it is likely to go into the markets as it becomes increasingly clear that we're in this return to stability, global growth is picking up, etc. Davos, on the other hand, they're in the scary business, right? Let's scare people, let's worry people, and that way they want to, they'll pay attention to us, the elites, the political leaders, the politicians. And so, I mean, I quote again in the musings from the FT's person on the ground in Davos. And here's what they say. Davos groupies have a predominantly negative outlook for the world over the next 2 years, with 54% braced for some instability and 30% predicting severe upheaval. So, I mean, thank goodness. I mean, to me, the Davos consensus is like the Economist cover, right? You can't go wrong taking the other side, right? That's point one. Point two, let's just look at some current examples, right? Middle East conflict, the price of oil. If geopolitical risk was a big deal for markets and risk assets, you have the upheaval in the Middle East, oil prices should be up significantly. In fact, reality, Brent crude is down 10% since October 7th, okay? Let's look at another one, China, right? Everybody is super fearful of US-China. And what about Taiwan? Taiwan had elections last weekend. What happened? Basically a wash. And by the way, the Taiwanese ETF, EWT, flat over the last 5 days. So history is very clear. Geopolitical risk does not move risk assets for any particular length of time.
All right, so listen, let's going to wrap that up there. But this weekend we've got playoffs in NFL again. I think all the favorites are going to win. But what are you thinking there, Jay?
Well, we wrote about this in Lean Into Complexity now a couple of months ago, really talking about how advanced NFL football is and how motion offenses are really creating problems for defenses. And this was on full display last weekend in the Packers versus Cowboys game, where the Packers, the fourth youngest team in the last 50 years to be in the playoffs, just completely toasted the Cowboys, who were heavy favorites, made the Cowboys look old and slow. So really continue to enjoy watching pro and college football at high levels. Really interesting to see how speed is being manipulated and utilized to leverage opportunities. And again, I write in the musings, we as investors also have to deal with speed. It's been a concept of ours for years. We wrote about COVID speed, analytical speed, narrative speed. So big thesis of ours, and it's playing out in the NFL and in high level sports. And so for me, I like the two Bs. I like Baltimore. I like Buffalo. And actually, I like 3 Bs. I like the Buccaneers as well, now that I think about it. And so I'm looking forward to the weekend. I plan to be watching a lot of TV. And if the snow falls, more power to it.
Sounds like a great plan, Jay. Listen, we'll see you again next week. Thanks for your time.
All right, Scott.
And for everyone else out there, good luck investing.